Hi, welcome to the second mini lecture for Chapter 3. What you're going to be learning in this mini lecture and the next are two of the most important concepts in financial accounting: the revenue recognition principle and the expense recognition principle. They form the foundation of what we call the accrual basis of accounting. This is the method required by generally accepted accounting principles and the International Financial Reporting Standards for external reporting. This lecture will focus on the revenue recognition principle and how to record revenues. Be patient with yourselves and watch this mini lecture again, or watch the concept overview dealing with this principle, or read the text until you really understand it. You will be using this principle throughout the semester, but also throughout your careers as managers. So let's first look at the definition of the accrual basis of accounting. This method reports revenues when services are provided or goods are delivered, and reports expenses when they are incurred. Remember that to incur means to receive the benefit of the cost. And this is regardless of whether cash is received or paid. According to generally accepted accounting principles and international financial reporting standards, the accrual basis is the only acceptable method for external reporting. Okay, let's first take a look at the revenue recognition principle. This principle basically tells you when a seller should report a revenue, and that is when the performance obligation is satisfied, when the goods or services are delivered. Let's take a look at page 2 of our summary notes. We see this 5-step revenue recognition model. Let's read it. The revenue recognition principle states that a seller should report revenue when it provides goods or services to customers. And here's the 5 steps. First of all, identify the contract, the agreement between a seller and a customer. Secondly, identify the seller's performance obligation, what the seller promises to do for the customer. Thirdly, determine the transaction price, the amount the seller expects to receive from the customer. Fourth, allocate the transaction price to the performance obligation, because more than one performance may be required by the contract. And finally, recognize revenue when or as each performance obligation is satisfied. And that means the delivery of goods or services. Now, it sounds simple, but it isn't as easy as it sounds. What I'd like you to do is really focus on this last one. Recognize revenue as each performance obligation is satisfied. In other words, when goods or services are delivered. And I think that's going to be challenging enough for us. Let's take a look at the next page, page 3, and we're going to focus on just the revenue portion, which is this very top portion here. Remember that when cash is received does not matter. We record revenue when the performance obligation is satisfied. That means when goods or services are delivered. Let's look first at situation A. In situation A, cash comes before the goods or services are delivered. And I'm going to put a little parentheses there so I know where my extra notes lie. Well, in this case, no revenue can be recorded, right? You have received payment before you provided the goods or services, so you cannot record a revenue. You owe your customer the goods or services. The word owe sounds like a debt, like a liability. Well, in fact, that is how you are going to record it. If you get paid before you deliver goods or services, then you will increase cash because you received it. But you will also increase your liabilities, specifically an account called Deferred Revenue. Now that's sometimes called unearned revenue, and you may hear me use that term when you watch the video dealing with a mini exercise in determining whether a revenue should be recorded. So it may be called unearned revenue or it may be called deferred revenue, but in both cases it's a liability because you owe your customer the goods or services. Let's concentrate for a moment on the word deferred. To defer something means to delay it, correct? You are delaying the recording of revenue until you have earned it. In the meantime, you'll record a liability, showing that you owe the goods or services. So when cash is received before sales are rendered, or before you've delivered the goods or services, you record it as a liability, and that we call a deferred revenue. Now, lots of businesses collect money before they deliver goods or services. Magazine companies that sell subscriptions and request payment ahead of time. Airline flights are paid for ahead of time. Sporting events such as Buffalo Bills games or Sabres games. Even gift cards. Now, when you eventually deliver the goods or services, then we will record a revenue. We will take the amount out of the deferred revenue and put it into regular service revenue or sales revenue. Now let's take a look at situation B, where you get paid cash at the same time that you deliver goods or services. In this case, because you have earned the revenue by delivering goods or services, you can increase the revenue account and also increase cash. In situation C, the goods or services are delivered, but the cash is not paid immediately. This situation happens when a company sells to its customers on account, which means on credit. You provide the goods or services, and the customer pays you in the future. In this case, you've delivered the goods or services, so you can record a revenue. But you didn't receive cash payment. So what else will you record? Well, we'll record an accounts receivable. That's the account we use to keep track of the money our customers owe us. It's an asset account. When they eventually pay us, we will increase the cash account and decrease the accounts receivable account because they won't owe us that money any longer. Okay, so now you know when to record revenues, when the performance obligation is satisfied. But how do you record them? Well, we're going to flip to page 4 of our notes. And I'm going to cover up part of those notes with a piece of paper here. If you recall from Chapter 2, the rules of debit and credit were based on this accounting equation. Assets are on the left side of the equation, so we increase on the left or the debit side. Liabilities and stockholders' equity are on the right side of this equation, so we increase on the credit or the right side. And to decrease, we simply do the opposite. We credit assets and we debit liabilities and stockholders' equity accounts. But I don't see anything about revenues and expenses. Well, let's think for a moment back to Chapter 1. There are two parts to stockholders' equity, correct? Common stock and retained earnings. Common stock represents the original investment of our stockholders. They give us cash and we give them common stock. Their equity or ownership in the company increases. So we have to follow the rules of stockholders' equity by increasing the common stock account on the right. The other part of stockholders' equity is retained earnings. Remember, earnings represent your net income. The word retain means kept, so your retained earnings are the net income over all the years of operation of the company, less any dividends that you didn't keep, that you gave away. So as we earn net income, we increase the retained earnings account, just the way we increase stockholders' equity. So the two parts to stockholders' equity, we remember from our balance sheet, are common stock and retained earnings. Both of them represent the stockholders' equity or ownership in the company. Well, one more step. How do we determine our retained earnings or our net income? Well, it's determined by taking our revenues and subtracting our expenses. Revenues are going to increase our net income or our earnings, so we'll record them on the credit or the right side because that follows the rules of stockholders' equity. Expenses get subtracted in order for us to calculate net income, so they're going to be on the minus or the debit side, how we reduce stockholders' equity. Both revenues and expenses are sub-accounts of the retained earnings account. So this chart is very helpful. There's another chart that I provided for you, or a review form, and it's called your Chapter 3 Essentials. It gives you your revenue recognition and expense recognition principles, and then it gives us our accounting equation and also highlights how revenues and expenses are recorded. Okay, your next step is to watch the video called How to Determine if a Revenue Has Been Earned. And in that, you'll get practice doing journal entries for situations like A, B, and C that we just reviewed. Then you can watch the next video, the mini lecture dealing with expense recognition rules. Have a great day.